So the profit reporting season for 2013 has just wrapped up. Industrial companies, we saw their earnings per share growth come out at about 4% as industrials in total. Continuing the sort of the positive trend we've seen over the last few years. I guess from our findings and our talking to companies is that sales growth, the top line, they're finding it very hard to achieve much. So companies are achieving what bottom line gains that they are making through cost out stories, and then they're doing all they can to pay out the highest dividend yield that they can. They're fully franked dividends. So we've seen reasonable growth in dividend income. So the industrials, the pick of the bunch for the industrial market have really been the big heavyweight index names. The banks, Commonwealth Bank reported their full year result. The other three majors reported quarterlies, and they're really showing just how powerful franchises these companies are. Those results were quite strong, albeit that the bad and doubtful debt charge that currently running through their numbers is very low. So if that was to increase, their profits would get knocked down quite considerably. The other big results of the supermarket chains, very strong. We thought the Tats result was very strong, owner of the lotteries, most of the lotteries around Australia. And a lot of the healthcare names produced very strong results. ResMed, Ramsay and CSL. On the other side of the coin, the resources, obviously still experiencing the pain of lower commodity prices and coming off very high levels of capex spend that they've done. We've seen them very aggressively and probably surprising the market on the upside in the sense of how they've cut costs. They've moved very quickly and aggressively to cut a lot of their costs. This is rippling through the economy, though, in the sense that a lot of mining services companies, we saw in their results the effect of this, and they had a pretty poor profit season, and we think that theme is going to continue. So a lot of those companies are still under a lot of pressure. So where to from here? What are we looking at? It's very difficult. I've said previously that in a very low interest rate environment, the dividend income coming out of companies is valuable, and so we've seen a lot of company share prices being bid up to levels that are, if not fully priced, then very fairly priced. So finding value is still difficult for us. On the good news front, I guess, is that we're in a low interest rate environment, and this will stimulate building activity and hopefully some retail activity. And there was some very early signs of that in the reporting season. We saw some building companies start to have a better second half. We saw some retailers report some month-on-month numbers, and progressively those numbers are getting better. So hopefully that bodes well for the next 12 months, where we see some of these cyclical companies start to have a better time of it. And also the falling Aussie dollar will benefit quite a number of companies in the economy. And also in positive news, I think the iron ore price, which is so important to so many of our listed companies, has proven much more resilient than what we thought and what a lot of the market has thought as well. So the higher that remains and for the longer that remains, that's very positive as well. The trouble is, I guess, is finding very cheap stocks that we can get very excited about, and that always remains the challenge. It's quite interesting to note that even though the price index, the All Ords, the S&P 300, is 25% below the all-time high in 2007. However, the All Ords accumulation index, so which includes dividends and assumes that those dividends are reinvested in the market, has actually now almost back to those all-time highs that it hit in 2007. So that really just shows you the importance of dividends to investors and to the market. And we remain focused on just buying those good quality companies where we think dividends are sustainable. We hope that the capital is sustainable, and the companies that have the balance sheets to withstand any surprises that come along in the meantime.